Advanced indicator combinations involve, strategically using multiple technical analysis indicators simultaneously to enhance trading accuracy, reliability, and decision-making effectiveness. Indicator confluence occurs when multiple independent indicators simultaneously provide consistent trading signals, significantly reinforcing trade validity. Traders prioritize confluence to systematically reduce uncertainty and enhance the probability of successful trade outcomes. Traders strategically select indicators based on complementary strengths, systematically applying them to gain comprehensive insights into market conditions. Momentum indicators, such as the relative strength index or moving average convergence divergence, help identify potential reversals, overbought or oversold conditions, and trend momentum. Combining the relative strength index and moving average convergence divergence effectively enhances traders' ability to accurately identify trading opportunities, confirm market momentum, and systematically manage risks. Both RSI and MACD provide valuable insights into market conditions, and their strategic combination significantly improves trading decision-making. All right, let's break down RSI and MACD, two really popular indicators out there. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of recent price movements. Basically, it helps us spot when something might be overbought or oversold. RSI values usually range between 0 and 100. Now, the Moving Average Convergence Divergence, or MACD, is a trend-following momentum indicator. It compares short-term and long-term moving averages, and it's used to highlight, potential trend reversals and the strength of that momentum. Traders often use RSI and MACD together to find the best trade entry points. For example, bullish entry signals happen when RSI moves up from those oversold levels, so below 30, and at the same time, MACD experiences a bullish crossover. That's when the MACD line crosses above the signal line. On the other hand, bearish entry signals show up when RSI drops from overbought levels above 70, and MACD has a bearish crossover, which means the MACD line crosses below the signal line. Now, confirming price reversals is super important, and traders do this by looking for divergences in RSI and MACD. A bullish divergence occurs when both RSI and MACD form higher lows, while the price itself is making lower lows. That usually suggests bearish momentum is getting weaker, and an upward reversal could be on the way. Meanwhile, a bearish divergence is when RSI and MACD form lower highs, but price is making higher highs. This signals that bullish momentum is fading, and a downward reversal might be coming. Traders strategically seek alignment between RSI and MACD signals, prioritizing trades with robust confirmation from both indicators. When both indicators provide simultaneous bullish or bearish signals, it really enhances trade confidence and validity in a significant way. On the other hand, if those signals are conflicting, traders exercise caution or look for additional confirmation, making sure they have robust validation before moving forward with any trade. Effectively combining RSI and MACD also means, sticking to disciplined risk management practices. Position sizing is key. Traders strategically adjust their trade sizes based on the strength and consistency of RSI and MACD signals, and when it comes to stop-loss placement, it's important to systematically place stop-loss orders below recent support for bullish trades, or above recent resistance for bearish trades, making sure your risk exposure lines up precisely with your trade setups. Effectively combining RSI and MACD can really enhance a trader's ability to accurately identify trading opportunities, confirm market momentum, and manage risks proactively. By systematically leveraging RSI and MACD alignment, spotting divergences, and applying strategic risk management practices, traders can confidently optimize their trading outcomes and, achieve sustained profitability over time. By combining moving averages with momentum indicators like RSI and MACD, traders can gain robust insights into both market trends and those subtle momentum shifts. This kind of strategic integration, honestly, can really improve a trader's ability to spot trade setups, confirm their signals, and manage risks more effectively. So let's talk about understanding moving averages in combination with momentum indicators. Moving averages are trend-following indicators that smooth out price data, making it easier to clearly identify market trends and potential support or resistance levels. Some of the most popular moving averages are the simple moving average, or SMA, and the exponential moving average, or EMA. Now, when it comes to momentum indicators, like RSI, MACD, and stochastics, These tools provide insights into both the strength and direction of price momentum. They help traders identify potential reversals and, trend continuations. Step 1. Identify the trend with moving averages. Traders start by clearly identifying the prevailing market trend using moving averages. For an uptrend, the price consistently trades above key moving averages, like the 50-day or 200-day EMA. On the flip side, in a downtrend, the price consistently trades below those moving averages. Step 2 is to confirm momentum with either the RSI or the MACD. So next, traders confirm the trend's momentum using RSI or MACD. For bullish momentum confirmation, you want to see the RSI above 50 and trending upwards, or the MACD exhibiting a bullish crossover. On the flip side, for bearish momentum confirmation, the RSI should be below 50 and trending downwards, or the MACD should show a bearish crossover. Let's look at an example of a bullish trade setup. First, price is clearly above the 50-day EMA, which indicates an uptrend. Then, the RSI rises above 50, signaling strengthening bullish momentum. The MACD also shows a bullish crossover, confirming that positive momentum. At this point, traders would enter long positions, placing stop-loss orders just below the recent moving average support. Now here's an example of a bearish trade setup. In this case, price falls below the 50-day EMA, signaling a potential downtrend. The RSI drops below 50, which indicates bearish momentum. The MACD confirms this with a bearish crossover. Traders would enter short positions, placing stop-loss orders above the moving average resistance level. Traders significantly enhance reliability by prioritizing trades exhibiting confluence across moving averages, RSI, and MACD. This robust validation ensures stronger signal accuracy and improved trading outcomes. Risk management considerations are, honestly, just as important. Position sizing means adjusting trade sizes based on the strength and clarity of indicator confluence. And systematic stop-loss placement? That's about clearly placing stop-losses at logical points, such as key moving averages or support and resistance levels, to align risk exposure with indicator signals precisely. Strategically integrating moving averages with momentum indicators like RSI and MACD significantly enhances traders' ability to identify reliable trade setups, confirm market trends and momentum, and manage risks effectively. By systematically applying these indicator combinations, traders can, confidently optimize their trading decisions and achieve consistent, sustainable profitability. Creating a reliable, comprehensive trading strategy using multiple indicators involves, systematically combining various analytical tools to enhance signal accuracy, improve decision-making effectiveness, and optimize trading outcomes. Below is a structured approach for developing, backtesting, and validating indicator-based strategies effectively. Step 1. Define clear trading objectives. Clearly defining specific trading objectives helps traders systematically align indicator selection, strategy parameters, and risk management practices with desired outcomes. Objectives include target returns, risk tolerance levels, preferred trading timeframes, and asset types. Clearly defined objectives provide structured guidance for indicator selection and strategy development. Step 2. Select complementary indicators. Choose indicators providing diverse yet complementary information, ensuring robust analysis and comprehensive insights into market conditions. Trend indicators identify market trends and overall market direction, such as moving averages or ADX. Momentum indicators evaluate momentum strength and potential reversals, like RSI, MACD, or stochastics. Volatility indicators measure volatility levels and potential price breakouts, for example, Bollinger Bands or ATR. Systematically selecting complementary indicators ensures comprehensive market analysis, enhances signal validation, and, minimizes false signals. Step 3. Establish clear entry and exit rules. Clearly defining precise rules for entering and exiting trades ensures disciplined execution and consistency across multiple trades. Entry rules include specific indicator signals, price patterns, or confluence requirements. Exit rules encompass predefined profit-taking targets, stop-loss placements, or indicator-based exit signals. Clearly articulated rules help traders maintain discipline, systematically execute trades, and honestly, effectively manage risks. Step 4 is all about backtesting the strategy. Systematically backtesting strategies against historical data helps evaluate performance, identify potential strengths and weaknesses, and validate the strategy's effectiveness. Backtesting assesses historical profitability, win rates, average gains and losses, and maximum drawdowns. Traders refine strategies based on backtesting insights, optimizing parameters, adjusting indicator combinations, or, modifying rules for improved performance. Effective backtesting ensures strategies are rigorously evaluated, objectively validated, and strategically refined before live trading implementation. Step 5 is to validate your strategy with forward testing. Forward testing means applying your strategy in real-time market conditions, either by using paper trading or by trading with small position sizes. This way, you're validating your strategy's effectiveness in a live environment. Forward testing really helps you assess real-time execution quality, market adaptability, your emotional discipline, and how effective your risk management actually is. Traders, continuously evaluate the outcomes of their forward testing. They make any necessary adjustments, or if everything looks good, confirm that the strategy is ready for full-scale implementation. Risk management and indicator-based strategies, it's absolutely essential. Effectively managing risk means sticking to disciplined position sizing, placing systematic stop-loss orders, and continuously monitoring and refining your strategy. When it comes to position sizing, you want to adjust your trade sizes based on the strength of your indicator signals, how many signals are lining up, and your own risk tolerance. For systematic stop-loss placement, you should strategically set your stop-losses at indicator-based levels, like key support or resistance areas, to make sure your risk management is clearly aligned with your strategy. Developing comprehensive indicator-based trading strategies significantly enhances traders' ability to accurately identify opportunities, execute trades consistently, and manage risks effectively. By systematically defining objectives, selecting complementary indicators, rigorously backtesting and validating strategies, and employing disciplined risk management practices, traders confidently optimize trading outcomes and achieve sustained profitability. Effectively integrating advanced techniques and comprehensive risk management practices into indicator-based trading strategies significantly enhances trading performance, profitability, and long-term sustainability. Utilizing sophisticated analytical methods, rigorous risk controls, and disciplined execution ensures optimized outcomes and effective capital preservation. Advanced indicator techniques. Divergence analysis. Divergence analysis involves identifying discrepancies between price action and indicator signals, signaling potential trend reversals or weakening momentum. Bullish divergence occurs when prices form lower lows, while indicators like RSI or MACD form higher lows, indicating weakening bearish momentum and potential bullish reversals. Bearish divergence is when prices form higher highs while indicators form lower highs, signaling weakening bullish momentum and potential bearish reversals. Effectively utilizing divergences, really enhances traders' ability to accurately anticipate market reversals and helps you strategically position trades accordingly. Multi-timeframe confirmation involves validating indicator signals across multiple timeframes, which, honestly, can significantly increase trade reliability and accuracy. Traders analyze indicator signals on longer-term charts, like weekly or daily, to confirm the overall market direction and trend. Then, shorter-term charts, such as hourly or intraday, provide more precise trade entries and exits, making sure they align closely with the broader market context. Multi-timeframe analysis in particular significantly enhances trading accuracy, signal confirmation, and, strategic decision-making. Customizing and optimizing indicators for specific markets, assets, or trading styles, it really does significantly improve indicator effectiveness and reliability. Traders, often adjust indicator parameters, like moving average lengths, RSI thresholds, or even MACD settings, so they align more closely with asset volatility, market characteristics, and individual trading objectives. Customized indicators can provide precise, market-specific insights, which in turn enhance overall trading outcomes and strategy performance. Comprehensive risk management techniques are honestly crucial. And when it comes to optimal position sizing, accurately determining trade sizes based on account size, risk tolerance, and indicator signal strength is just fundamental for effective risk management. Traders systematically limit risk exposure per trade, making sure to ensure sustainable trading practices, capital preservation, and, of course, minimized losses. Effectively placing stop-loss orders at indicator-defined levels, such as key support or resistance points, significantly limits downside risks. Disciplined stop-loss placements ensure trades exit promptly during adverse market movements, preserving capital and enhancing trading stability. Regularly monitoring indicator-based strategy performance, evaluating trade outcomes, and adjusting strategies proactively is essential for effective risk management. Traders continuously refine strategies based on performance insights, adjusting indicator parameters, strategy rules, or risk management practices for optimized outcomes. Traders must avoid excessive reliance on indicator signals alone, incorporating comprehensive market analysis, economic context, and technical confirmations to validate trades robustly. Ignoring risk management, well, it can really come back to bite you. Neglecting disciplined risk management practices significantly increases potential losses and undermines strategy effectiveness. Traders must consistently apply rigorous risk controls, disciplined position sizing, and systematic stop-loss placements. Integrating advanced indicator techniques with comprehensive risk management significantly enhances trading performance, consistency, and long-term sustainability. By employing sophisticated analytical methods, rigorous risk controls, and disciplined execution, traders can confidently optimize their trading outcomes, effectively preserve capital, and achieve sustained profitability. Like, subscribe, and share for more insightful trading strategies and tips. Disclaimer: the information provided in this video is for educational purposes only and does not constitute financial advice. Always perform your own research or consult a professional advisor before making any investment decisions.